Okay, we're going to get into chapter 1-2. This starts on page 9 of your book. And I will tell you, the first chapter 1-1, I realized that it was about 25 minutes long, but that was kind of an introduction to some of the things that we will be doing over the course of the semester and the year. Chapter 1-2, how business activities change the accounting equation. And as you remember, again, if we're looking at page 9 here, assets equal liabilities plus owner's equity. That's very, very important to understand. The left side of assets has to equal the balance of the right side, which is liabilities and owner's equity. Business activities change the amounts in the accounting equation, as I just stated, and business activities are mainly either selling something of your business, or you're collecting cash, or you're buying supplies or insurance, or you're investing in your own company, things like that. Those are called transactions. And the first transaction that we're going to talk about is right here in the middle of this first column. It says received cash from owner as an investment. So Miss Trevino, she has Encore Music and she wants to start a business. Well, obviously you can't just start a business with zero equity. You just can't go into it with $0. You have to have something. So she saved up $10,000 of her own money, and she's saying, okay, I'm going to start my own business. So she takes that $10,000, she puts it in the business checking account. Again, personal checking account has to be separate from your business checking account. So she takes $10,000 of her own money and she puts it in the business checking account. So we need to record that transaction. Again, we need accurate accounting records, financial records, so that we can stay afloat, so that we can stay in business and continue to make money. Well, hopefully make money, hopefully a lot of money. So transaction 1 is on August 1st, received cash from owner as an investment. And we're going to talk about which accounts in our financial documents that those are going to affect. And it talks about accounts right here, and it says a record summarizing all the information pertaining to a single item in the accounting equation is called an account. And let me just simplify that. Each cash, supplies, owner's equity, everything has an account, and everything has an account name or an account title to it. For example, I threw the one of cash. The categorization of cash is an asset. We're going to get more and more into that here in this chapter. So we have accounts. You're going to have multiple accounts that we need to keep track of balances of each account, and each account has an account title. So that kind of goes through this section here. As we look in the upper right hand corner there, the second column, in the accounting equation shown above, the asset account cash is increased by $10,000. So we took maybe $10,000 out of our personal cash and we put $10,000 of our own personal cash into our business account in our bank. So we have $10,000 of cash now in our bank account for our business. So it's going to increase this side. It's going to increase our cash by $10,000, and we're going to go through this here on the next slide as well, but let me just finish up with this. Now, when there's a transaction made, there's always two accounts that are affected. In this case, cash is the first one, and since this is equity, since we said assets equal liabilities plus owner's equity, we don't have any liabilities yet. Zero liabilities. So we also have to have $10,000 in our owner's equity. And again, owner's equity is what the company is worth. So we have assets of $10,000 and we have owner's equity of quote unquote what the business is worth, $10,000 as well. And you're going to notice that here in the transaction. So we have $10,000 in cash and we also have $10,000 in owner's equity. Now that does not mean that we have $20,000. But again, if we had any liabilities, which our liabilities are people that we owe money to, we would subtract that from our assets to get actually what we're truly worth. So if we had $2,000 in liabilities, our owner's equity would only be $8,000. Again, left side has to equal the right side. Assets have to equal liabilities plus owner's equity. Owner's equity is what the company is worth on paper. Assets are what we actually have physically: trucks, equipment, supplies, etc. Okay? So let me go back, and we're still on page 9 here. And that kind of summarizes the rest of this section. I want you to read this section here. The account balance, there's always going to be an account balance for each account. So most of the time when we start a business, there's going to be balance of zero. There's zero cash. There's zero owner's equity. There's zero liabilities. There's 0, 0, 0. Well, once we start making transactions, i.e. investing $10,000 of our own money into our business, we've now affected two accounts. Cash is an asset, $10,000. Owner's equity is actually owner's equity account, or categorization, is also $10,000. And it's actually capital. We're going to call that capital. And that's what this second part of this column talks about. And I want you to read that thoroughly so that you understand the very first transaction of the accounting process. I want you to go ahead and turn the page. Again, if you want to refer back to this PowerPoint, you can download this PowerPoint and kind of get an idea. This is also the same thing that's on top of page 9. So let's get to the next page here. Page 10, we're going to talk about the second transaction of our business. Okay, and second transaction is that we paid cash for supplies. And if you notice on page 10, on the left-hand column, it says transaction 2, August 3rd. We paid cash for supplies. Now, supplies could mean anything from cleaning supplies, toilet paper, desks, chairs, whatever you need to stock an office or a business, those are your supplies. Supplies are still worth money. Those bookshelves, those chairs, those desks, those barber chairs, anything that you have in stock are all considered supplies. And for Miss Trevino's sake, she teaches music lessons. It might be a bunch of instruments and paper and music books and things like that. Those are all considered supplies. They're all worth money. Therefore, they are assets. So on August 3rd, we paid cash for supplies. And again, I want you to skim through this quickly, but what I just told you is the gist of transaction number 2. Paid cash for supplies. We're stocking our business. Okay? If you notice at the top, paying cash. Transaction 2, paid cash for supplies in the amount of $1,577. So if we're looking at assets equal liabilities plus owner's equity, here are our accounts so far. We have a cash account. We have a supplies account. And we also have a prepaid insurance account, which we're going to talk about in the next transaction. Prepaid insurance is insurance for your business. If your business were to get flooded or if it burnt down, your insurance can cover the expenses of the assets that you lost. Okay? So if you lost all those chairs and all of your supplies and all of your desks in a fire, your insurance will recover you the cost of those, and so that you can get back in business. But insurance costs money, as you know, if you own a car. House insurance, car insurance, property insurance. So we have a prepaid insurance account as well, and that falls under the assets because, again, it is worth money. Because we paid for it, it's actually, the insurance is worth money, and it depreciates over time. Now our liabilities, we still have zero liabilities. We have our owner's equity. Again, $10,000 was invested initially. This transaction here, transaction 2, we paid cash for supplies. So if we pay cash, we're going to minus that out of our business checking account, $1,577. However, we gained assets because supplies are worth something, no matter what the supply is. Until we use it or until it's out of our business, it's still worth this amount. So even though we minused $1,577 out of our cash account, we added $1,577 to our supplies account, which still equals $10,000 and $10,000. So that is transaction 2 right here on page 10. Now let's look at transaction 3. It's very, very similar. Again, we're paying cash for insurance. Again, insurance is going to cover if we have a loss, a fire, flood, tornado, etc. Um, it'll be able to reimburse us for all of our assets that we lost. So we have insurance, and the bank, if you owe them money, they make you have insurance. So they always want their money back. So let's take a look at that transaction. We paid cash for insurance. Let me make sure. Yep. This is transaction 3. Paid cash for insurance of $1,200. Now, again, insurance, this might be monthly, it might be yearly, it might be every 6 months. It depends on what insurance coverage you buy. So we have our balance of cash, which was $10,000 minus the $1,577. So we have our balance here. We have a new balance in supplies of this. We have zero balance, and we still have that $10,000 balance in owner's equity. Well, here's our next transaction, paid cash for insurance of $1,200. So we're going to minus $1,200 for cash, and we're going to increase the prepaid insurance account. Again, this is still going to equal $10,000 and $10,000. And if you look at our new balance, these three amounts equal $10,000, whereas this side also equals $10,000. Assets have to equal liabilities plus owner's equity. But all in all, cash, supplies, prepaid insurance are assets. They are worth money to your business. Liabilities, things that we owe, people that we owe, businesses that we owe. Right now we don't owe anybody. Owner's equity is what the business is worth. So left side has to equal the right side. I'm going to move on to page 11 here. The fourth transaction that we're going to talk about, the fourth transaction that we're going to talk about, fourth and fifth, is bought supplies on account. Again, I'm on page 11. Encore Music needs to buy additional supplies. However, the supplies, they don't have enough cash to buy all of the supplies that they want. Or maybe they don't want to spend a majority of their cash just on supplies. So what they've decided to do is go to this Ling Music Supplies, and Miss Trevino goes to this other business and says, listen, I'm a new business. I need some extra supplies. I don't have all the cash to pay you right now. Can I pay you in 30 days or 60 days or 90 days or make it a payment plan? Ling Music decides, okay, we can do that on, maybe an interest rate. So Miss Trevino gets all her supplies, but she might owe the other company that she bought those supplies from. She might owe them in 30 days, and we call that buying supplies on account, or buying an asset on account. It could be a truck. You can't pay for the whole truck up in advance. We're going to pay you at a later date. We bought the truck on account. A house, anything we can buy on account. It means we owe that other business, money at a certain date. So let's talk about that one first here. Transaction 4, August 7th, we bought more supplies on account from Ling Music for $2,720. Again, this is on page 11 right here if you need to refer back to that, and this is the transaction we're looking at. So our balance of cash we've already determined from the previous 3 transactions. Here's our balance. Here's our balance of supplies. Here's our balance of prepaid insurance and our capital. Now, we bought supplies on account. Since we bought supplies, again, supplies are an asset. We're going to increase our supplies. Okay? However, we didn't pay cash for the supplies. We bought it on account, which means that we owe Ling Music $2,720 at a later date. So if we add to this side and we add to this side for each account that we have, it still equals, well, it doesn't equal $10,000 now. It equals $12,720 on each side. Not $10,000, $12,720. So they still equal. Assets still equal liabilities plus owner's equity. Let's take a look back at page 11. The second one is we're going to pay cash on account. So we bought it on August 7th from Ling Music. Now, 5 days later, or 4 days later, we're going to pay them half of what we owe them. So we're going to pay them back. And this is how this is going to work. Again, this is from page 11, second column here. Paid cash on account to Ling Music. 4 days later. We owed them money. Now we don't owe them as much money. We're going to pay cash, so we're going to subtract this from our cash account. We originally owe them $2,720. We're paying them $1,360. So we're going to subtract it also from the right side from their account, $1,360. So again, both sides still equal, assets still equal liabilities plus owner's equity. We get to our final balances after these 5 transactions, and this is what we should have. $5,863, $4,297, $1,200, $1,360, and $10,000. These two sides equal each other, and that has to happen. If these two sides do not equal out, you need to go back and figure out where your errors are. And maybe you added it or subtracted it from the wrong account. If these totals do not add up, again, to equal out each side, you need to go back and figure out which errors that you made. That's the end here of the PowerPoint. We look at the terms to review. Again, audit your understanding of 3 questions: the work together and the on your own. Here they are right here. If you open up your file and you go down to the bottom of your tab, 1.2 lesson, here are the terms. Again, I want them written out right along here in red. Audit your understanding, written out right here, typed out in red, incomplete sentences, please. Let's take a look at the work together. This is on page 12. Work together says, write the answers to the following problem in the working papers. Your instructor will guide you through the following example, which I'm about to do. For each transaction, place a plus in the appropriate column if the classification is increased. Place a minus if the appropriate column in the classification is decreased. Transaction 1, bought supplies on account. So when we buy supplies on account, again, supplies are an asset. So we're going to put a plus sign here. Oop, I don't want that. Hit enter after you hit the plus sign, which is shift plus equal sign on the keyboard. We bought supplies on account. That means we owe somebody money at another time. We can't minus a liability because both of these sides need to be equal. So this is going to be a plus sign. We bought supplies, asset, on account, which means a liability. Again, we owe them at a later date. Second transaction says received cash from owner as an investment. And this was the first transaction in 1-2 that we talked about. We received cash. This again. So this has to be a plus. Received cash. Cash is an asset. And we received it as an investment. You have to hit enter after the plus sign or else it looks at it as a formula. So again, we're going to put plus sign in the owner's equity and hit enter. There we go. Third transaction. Paid cash for insurance. So if we pay cash, that is a minus. Anytime we pay cash, it's a minus. Hit enter. And actually, we paid cash for insurance, which again, insurance is an asset. So at the end of the minus sign, I'm going to put a backslash, and I'm going to put a plus. Hit enter. Uh-oh. Let's put plus backslash minus. Still not letting me do it. Let's do this. Plus minus. And let's shrink this down a little bit. There we go. Again, on this transaction, we paid cash for insurance. We're going to minus our cash. We're going to add to the other asset of prepaid insurance. And that's all for that one. On the fourth transaction, paid cash on account. We paid cash, which means a minus. Keep doing this here. And we paid cash on account, which again is on page 11, the fifth transaction. We're going to decrease what we owe that other person. So when you're doing this next one on your own, make sure it looks something, it's going to look like this. I've already formatted it for you. If it's plus minus in the same box, make sure you just write out plus minus and hit enter after you hit the plus sign. You can also go back through 1-2 on those 3 pages and look at those 5 transactions and figure out which accounts are affected. There's always 2 accounts affected per transaction. Okay, and you just need to figure out with assets equals liabilities plus owner's equity, which accounts, whether they're increased or decreased, or both. If we're paying cash for another asset, we're minusing cash, we're adding to our asset. So take a look at this. Email me with any questions, but this should make sense to you. This was on page 12.